Good afternoon, ladies and gentlemen. My name is Ryan Suter. I'm one of the senior investment managers here at Sharewise, and we're here this afternoon with Glenn Corrie. Now, Glenn's been kind enough to lend us his time and expertise as the CEO of Hazer Group. Now, Glenn, can you just do us a favour, mate, and give us a bit of an introduction to Hazer?
Sure. I'll talk about the plant behind me shortly. Hazer's it's a very unique technology company. We've been in development for about 16 years, 17 years. We've spent a huge amount of money developing what is a world-class and a first-of-a-kind technology to effectively decarbonize gas, produce hydrogen, graphite, and accelerate the pathway to clean hydrogen much faster than anybody else in the world today. So it's an exciting tech. We have been, like I say, been working on it for a number of years. We've got some world-class partners that have joined forces with us to effectively develop the technology as well as take it on board into their industrial applications. And we see this as a potentially game changer for decarbonizing industry through both a hydrogen product, a very low emissions graphite product, as well as general overall decarbonization of industry.
All right, brilliant. Thank you for the introduction, Glenn. Now, I will hand it back over to you shortly, just to run us through a bit of a presentation you've got. But ladies and gentlemen, I'd like to remind you that following Glenn's presentation, we'll open the floor up for a bit of Q&A. I've got a couple of questions here which I'll kick us off with. But if you would like to submit questions for me to ask to Glenn live, please do so through using the Q&A function on Zoom. Glenn, I'll hand it over to you, mate, for the presentation.
Thanks, Ryan. This shouldn't take long. Quite keen to get into the Q&A, and hopefully this will cover off on some of the questions, but really happy to go in any direction on market, tech, some of the news flow that's out there at the moment. But Hazer, for those that are not familiar with it, stands for actually Hydrogen and Zero Emissions Research. That was the vision of the company 17 years ago. That's the reality of the company that we've got today. There's a beautiful picture there in front of the viewers in terms of our commercial demonstration plant, which is operating today in Perth in Western Australia. So a really exciting technology, as I've said, and I'm going to tell you a little bit more about it if I can get the slides to work properly for me. So we're very simplistically, we're decarbonizing gas. This is a world-leading climate technology. And as I said, we are accelerating the pathway to affordable clean hydrogen and low emissions graphite at scale, much faster than any available technology today. You'll have heard lots about green hydrogen. You'll have heard lots about blue hydrogen. I hope today that I can sort of demystify a little bit of that and just really point out, how competitive that we are in the market relative to both green, blue, and a really viable economic pathway to clean hydrogen. There's some really unique characteristics of our technology that I think just are worth ticking apart. We're an advanced TRL. For those that are not familiar, TRL stands for Technology Readiness. It was developed by NASA ages ago, but we're number 7 on the scale of 9. So that gives you some visibility on how advanced we are. As I've said, it's 17 years of development, and we're ready for commercialization today. So that's key. We're low cost. In fact, we're one of the lowest cost in the market, and that's driven by technologically very low process energy intensities. It's the development of our process that's really important. It's a lot of the IP that we do, in particular the use of a catalyst that drives down the use of our energy, and that drives out very attractive economics and very attractive low carbon emissions. Proven scale. This is a technology using we've adopted a reactor and a heating system that's come from refining and the metallurgical industries. We know that's proven, and we know that can enable our technology to scale up to very large scales to decarbonize very large industries like steel making, cement, petrochemicals, ammonia, you name it. So it's a technology that can get up to very large production scales. We've got a very unique graphite alongside of our hydrogen. The graphite's a critical mineral. Everybody knows that, and everybody also knows that that the majority of the supply today is coming from China. There's a sovereign risk with that. Hazer's technology can deliver a low emissions, large volumes of graphite to the world over time. So it's a really unique technology in that respect. We plug in and we drop in our tech, this tech here, to any industrial facility worldwide using existing value chains, using existing infrastructure, and that reduces the requirement for moving hydrogen molecules around the world, which is hard. So being able to plug it in and provide hydrogen over the fence to a customer is a real advantage and reinforces our low-cost model. And we've got first mover. I'm going to show you a map shortly of all of the partners that we've got, but we've got tier one blue chip partners around the world that are starting to pick up our technology because of its competitiveness and also the low-cost nature. So that's kind of, I guess, a bit of a snapshot of the tech. Maybe just stepping back to the market, Ryan, because I think the market's kind of worthwhile unpicking a little bit. Most of the hydrogen today is produced by a process called steam methane reforming. You'll see that on the top right-hand corner. Steam methane reforming, every ton of hydrogen produced comes with 11 tons of CO2. So it's a massive amount of CO2. And so I refer to it as dirty hydrogen. The entire market today, that 100 million tons per annum, is all dirty hydrogen. Okay, so it's actually 1 billion tons of CO2. And that's Hazer's disruption, our ability to displace and disrupt that technology or that process with a cleaner technology that can provide clean hydrogen into the same industrial applications with the same feedstock at a similar price point. So that's the real disruption of Hazer. To put this market in context, that's a quarter of the LNG market. It's basically around 180 to 190 billion dollars of US dollars of total addressable market. So it's a massive market, massive problem, and Hazer's got a very viable solution. So here's what Hazer does. We decarbonize gas. We take any methane-rich gas, pipeline gas, LNG, biogas. We effectively convert it and split it into clean hydrogen and carbon in the form of graphite. The X factor that we bring and under intellectual property worldwide is the use of a very cheap and affordable and abundant catalyst in iron ore. And that drives down the reactor temperature significantly to around 800 to 900 degrees. That's almost half of what everybody else in this space is trying to do. So that is our advantage, a thermocatalytic process using a very cheap and abundant catalyst to deliver one of the cleanest and cheapest available forms of hydrogen today. So one technology that serves three markets: the hydrogen market, the critical mineral market through graphite, and of course overall decarbonisation. And I talked about this fluid bed reactor. That's one of the keys to success because that's our pathway to scale. It's proven and it's been adopted from refining and metallurgical industries. And we know that they get up to very large scales, and we're not putting novelty on top of novelty. So it's a pretty standard process using adopted technologies and processes to get to effectively a clean and affordable hydrogen product stream. We've been on this journey 17 years. It is $120 million of invested capital. It's been successfully scaled up 5 times to this plant on the right-hand side, this commercial demonstration plant, which is operating today. Every time we've scaled up, we've got really good data. We've been operating now for a year, almost a year at our CDP, and that's going very well. We're getting some great results. The methane to hydrogen conversion rates are approaching design limits and getting close to where we need them to be. We're getting bags of graphite, and you will have just seen, or at least investors and observers of Hazer would have seen, that we've just pushed through over 360 hours rather of continuous operations. So we're well on our track, on the right track there to full commercial readiness by the end of this year with our technology. And of course, all of that is going to be feeding into our commercial project pipeline, as you'll see on the right-hand side. We plug in, like any process, we effectively will provide here hydrogen to the customer at the demand point. As I said, that eliminates any risk and any cost of transporting hydrogen molecules around the world. I always say the best way to get hydrogen to locations is through gas and LNG and pipeline gas. And of course, at the destination, we will just split it into hydrogen and graphite, providing a product stream where the customer demands it, and again, eliminating that risk of cost and transportation. The graphite's worth talking about. As I said, it's a critical mineral. People in Australia would at least appreciate that Australia has a long list of critical minerals. Graphite's in the top 10. It is the only one in the top 10 that Australia doesn't produce domestically. China controls about 60 or 70% of the global supply market. That's a sovereign risk, of course, for folks. Hazer and its technology and the volumes that we'll produce could be a real substitute for some of that. It's a very unique product. It's low sulfur, low ash. It's importantly low emissions, so it's a clean graphite. It's a very structured and crystalline form of graphite, so we can see applications all the way from steel making, cement, water purification, asphalt, bitumen, a long list of applications in the graphite market. And those who watch the stock will have seen that this morning we put out an announcement and we're extending our strategic collaboration and partnership with the Mitsui Group, one of the world's largest trading and investment groups based in Japan. We've been working with them for almost 2 years and some really positive results and feedback coming from the market. And that really has been the catalyst to extend our partnership. So we're focused on high confidence markets that can deliver high volume and provide pathways for offtake. And we're continuing to explore those markets with Mitsui and also independently. But this could be a real value kicker. Everybody talks a lot about the hydrogen and the importance of it, but if you put the two product streams together, our graphite and its low emissions components could be a real value kicker for our technology. On to cost, everyone talks about the cost of hydrogen. In the US, this is a really good chart to show how competitive we are. And coming back to that original comment around green hydrogen and blue, we can deliver today hydrogen into the US at current gas prices for around $1 a kilogram. That's very cheap. That is about a third of the cost of blue, and conservatively, that is probably a fifth to a sixth of the cost of green hydrogen. And the reason why it's so cheap relative to green is simply chemistry. It is 7 times harder and requires 7 times more energy to split a water molecule, like you do through electrolyzers and green hydrogen, than it does to split a gas molecule with what Hazer does. So you can see immediately that the chemistry is driving the cost and the energy that's required for that. So you can see how competitive we are. Now, if you jump to Asia or Europe, of course, relatively, it's going to be a little bit higher because gas prices are higher, but everything else is going to be higher as well. But the margin should stay the same, and we can deliver, as I've said, very cost competitive gas against most forms of hydrogen production types today, and importantly, disrupting that very dirty form of hydrogen in SMR, which is called grey hydrogen. So you'll see here the pipeline, or at least the 4 foundation customers that we have now secured, plus others. We've got first mover advantage in key markets around the world: North America, Europe, Asia Pacific. These names will be very familiar to folks on the call. Chubu Electric in Japan is one of the world's largest LNG importers. ENGIE, again, a global giant in terms of energy and power utilities. Fortis BC, we've got a project that's advancing towards FID in Canada. Mitsui, I spoke about. POSCO, a really important new customer for us, decarbonising steel. They're developing a process called Hyrex, and Hazer's technology actually fits wonderfully into steel making using a catalyst that's iron ore, hydrogen, of course, for DRI and electric arc furnaces, and as well as graphite. There's multiple uses and applications for Hazer's graphite in the steelmaking process. So 3 triangle points come together in steelmaking. And behind this, we've got over 25, 30 commercial conversations relating to the potential use of our technology as well as strategic discussions. So a really exciting tech that's starting to get traction. I like to say we're sort of running and chewing gum at the same time, because whilst we're tech developing, we are actually securing customer base, which is validating what we're doing along the way. Here's our growth ambition. I love the fact that we have a very ambitious vision. I also love the fact that we're not there yet, because that's what keeps us motivated to get to the finish line. We dream about the fact of having 10 plants in 10 years. We've got 4 big customers already, so we think we're on the right pathway to achieve that objective. If you plug all that into a model, you get anywhere between 500 and $1 billion unrisked. So it's got the potential, this platform, to be very large. We know the disruption's there. We know the market is large. We know the tech is working. It's de-risked. We know we've got the customer base validating that, and we're on a fast track to accelerate, the transition at least into the commercial world for our technology. Ryan, that was all I had to sort of kick things off and get the juices flowing. So very happy to sort of pause there and open up the floor for questions.
No, that's absolutely brilliant, Glenn. The juices are definitely flowing. All right, well, I'll kick us off with a couple of questions before we shift to live participator ones. Now, the first thing I got for you, mate, is obviously, this is a clean process. It's one that's, could be considered to be, something it's positive for the public market and arguably the greater good. How are government agencies obviously supporting the growth of technologies like yours?
Yeah, they're doing okay. It depends on where you are in the world. I mean, I will just give a plug briefly to the Australian Renewable Energy Agency, who's backed us to at least support the development and the construction of the CDP behind me here. They gave us a non-refundable grant a number of years ago to help us develop that. So strong support, at least from ARENA. And we've actually got some more ARENA milestones coming in our sort of cash forecast, which is great to keep things moving along with them. On the flip side, Australia's got a policy, a hydrogen head start is kind of leading the charge on that front. We're a little bit disappointed that it sort of didn't cover technologies as much as it should. It really had focused on green hydrogen projects. I think you've seen the news flow with Origin and Fortescue and others sort of taking a step back from those projects, really on the basis that the costs are high, as I've pointed out. They're really not economically viable today. And again, I'll just reiterate, we're not green hydrogen. We deliver and decarbonize gas to get to the same product for, a seventh of the cost. So we would like to see policy change a little bit. We're, of course, engaging with all stakeholders on that front. And we know this industry is changing all the time. If you jump to the US, the Inflation Reduction Act is very supportive of technologies. Different thresholds, a lot of money flowing into hydrogen technologies, a lot of money flowing into products, and they don't differentiate between green and blue and turquoise. They say if you can produce hydrogen under a certain threshold, you get some funding. And we'd love to think that the Australian policymakers could start to, take some of the leaves out of that book and that playbook rather, and see if we can start to think about that. This is a homegrown technology that is going to the world. And of course, everybody who's been around technologies knows that, they need a lot of support to get off the ground. We're 9/10 of the way there, and, we could always do with a bit more support.
Yeah, I understand. All right. Well, thank you for that clarification. Now, just to shift here to more of a niche business aspect, obviously, can you just walk me through your business model? Obviously, I understand you guys operate on a licensing model, but when it comes to actually generating the revenue, especially in future years to come, what does that look like, and how exactly does that kind of operate?
Very good. So we like to say that our business model is CapEx light. It means we don't build things, because building things are expensive. We're not a big company, and of course we need a lot of people to build things. So we've done a lot of the building to get the tech to where it is. It's 5 times scale. So we're about licensing our technology. So that means not a lot of cash goes out the door. We've spent $120 million developing it. We think that's close to what it needs to be now to start licensing the tech. And as you can see, the customer demand is already there. So our model is licensing. And if you break that down, it's sort of 2 components, or it's really 3 components. Early revenues from engineering services. So as we work with customers and prospective customers in the early phases of our engagements, we will receive, income and recovery of costs to support the development of that project. And that's what I would call early engineering service revenues. And you can see that already flowing through to us now from our partner in Canada, in Fortis. We've received already 2 of those payments. So that model is working.
Yeah.
And then as you hit FID or final investment decision for projects, there will be a license fee kick in. And that's a substantial uptick in then, of course, the revenue stream. And then as production kicks in 2 or 3 years later, royalties will start flowing on the hydrogen production as well as the graphite production and possibly carbon offsets in the future. If you put all that into an economic model at scale, one plant here at 50,000 tonnes per annum can deliver up to $100 million of NPV for Hazer. Okay, so it's a huge amount of, and that's only on a 4 to 5% royalty scheme. So it's a very competitive, low cost, high margin tech that throws off for us a lot of cash because we don't put in, and accelerates the pathway to cash because we don't put in a lot of capital into the projects, and that delivers early free cash flow for us. And again, one plant being 100 million, it doesn't take many for this platform to be 500 or $1 billion. So people can do the maths on what that takes, but that's what a particular large scale project would deliver for Hazer as a royalty stream.
Okay, and just obviously on the topic of taking a capex light position, does that not inherently though increase the barrier to entry for clients to want to pick up this tech because they know that they have to pick up their initial license fee and then spend X amount of dollars on actually implementing the technology into their own infrastructure?
Yes and no. I'd say no mostly because most of the customers and prospective customers of ours are comfortable building capital projects or working with engineering groups to develop them. These are customers that need a decarbonisation solution today. They're not prepared to wait for green hydrogen because that's 10 years from now. And they can see the competitiveness of what we're doing, and they have either in-house capability to develop projects or they will bring in big engineering groups to support that. So in most instances, we see that, it's not a complicated piece of kit, Ryan. This is a largely industry standard equipment. I'm not going to say it's off the shelf, but other than the reactor, which is quite novel, but again, re-adopted from a previous industry, none of this equipment here will frighten anybody because they're familiar with a lot of the equipment, piping, separation materials and so forth. So it's not a complicated piece of equipment. What is novel is the IP and the intellectual property and the use of catalyst to produce low cost hydrogen and graphite.
Okay, well, thank you for that clarification. Now, obviously, given the new risks, given the risk period involved in, adopting and utilizing new technology, how has Hazer gone about de-risking themselves at the current stage of the business? And realistically, when it comes to building investor confidence, what milestones have you guys achieved when it comes to scalability and then obviously commercial viability?
Very good. So the de-risking is mostly done. 5 times scale, the CDP is working. It's been operating for a year. I think we're comfortable to say the tech is working and working at scale and working at commercial, viability scale. So that's a big tick for us. And we've got a few more things to do, and that's understandable, but we continue to push through that. The milestones, I think, are talking to themselves. Whilst we're developing the tech and getting the CDP up and running and doing what we need to do on the tech readiness side, we have got the commercial projects. The first one off the rank is Fortis BC in Canada. That's taking in a final investment decision next year. That is another de-risking and inflection point for our technology. But we're already through feed for at least the main plant, and we've got the reactor at commercial scales in design, and we're also plugging in the prototype for that into this plant in the coming months. So there's lots of de-risking along the way, but also there will be commercial de-risking as we go through the commercial discussions and start up and getting to FID for the first plant. The first is always the hardest. Once we're at FID next year, then I think, we're in a very different world as a company because we've got a big, deep pipeline of customers that are waiting for that, the tech.
Okay, brilliant. Thank you for that one. Now, let's just, shake this crystal ball and see if we get a bit of future outlook. When it comes to growth in the next 12 months, what do you reckon Hazer's biggest groups are going to be?
Look, we're on a trajectory of massive growth. I'd be disappointed if we don't have another couple of big customers signed up. We've got lots of dialogue going. As I've said, once the market starts to unravel, I saw one of the questions earlier. Once the market really differentiates and understands how we're different from green hydrogen, Ryan, then they will start to get it. I wouldn't be a good CEO if I didn't say we were deeply undervalued. When I look at the economics and I look at what the tech is doing and I look at the customer base that is out there, this is a large scale company that has got the potential to really disrupt the hydrogen sector and industry worldwide. And I talked about numbers. It doesn't take many of these plants to be, a $500 million company or beyond that. And, I think we've had a few headwinds with the green hydrogen narrative. But I think as we start to bifurcate from that and people really understand the simplicity and the low cost nature of our tech, I think, the market will start to get it.
Okay. Well, thank you for that. Now, obviously, when it comes to, obviously further scaling the company globally, obviously, 100 tons per annum capacity at the CDP. How do you really see the company scaling to much larger commercial projects globally?
Yep. So we're 100 here. We're going 25 times in Canada, so that's 2,500 tons per annum. So that's a big step. And then beyond that, it gets easier. All of our scale, really, the big steps have been taken. 60 times, 30 times, 25 times to Canada. And then beyond that, to meet some of the demand levels that we've been seeing, to get to 50,000, you're talking really only sort of 8 to 10 times. So you can see that the steps are getting smaller, but we're only really getting a reactor that's getting larger. Once the reactor is proven and works, and like we are doing at the CDP, going from a meter in diameter to 2 or 3 meters in diameter is not a big step anymore. I think, the hard work's been done in terms of de-risking. Of course, there's always risk as you scale up, but the big steps have taken the small steps ahead of us. And it's really about how do we optimize the technology now for each particular customer. But that's the sort of pathway. We're already on 25 times scale. We're TRL 7 going to TRL 8. TRL 9 is commercialization. So we're one step away from that. But I think, as you can see, the pipeline's building out and we're actually developing projects at sort of those large scales.
Okay, well, thank you for that one. Now, obviously, you spent a lot of time discussing the next largest step for Hazer being in Canada. Where do you see, or which regions and markets do you see being the most promising for expanding their footprint?
Yeah, very good. So we're getting a lot of demand pull from the US and North America at the moment. It is an attractive place to do business for our technology, low cost gas, a lot of access to capital. So there's a lot of investment firms there. There's a lot of industry. There's a lot of players looking to decarbonize and very supportive government policy. So North America, big demand pull. I would also say that there's equal demand pull for different reasons in Asia Pac. In Asia Pacific, limited access to blue hydrogen or sequestering carbon under the ground, limited access outside of Australia to renewables, a big gas market that needs decarbonizing and big industry with big industrial players. So I would say Asia Pac and North America leading the race. Europe, we're watching. Of course, we've got a big partnership there with ONG, and we continue to develop opportunities in Europe. Policy-wise, they're still working their way through it. So we keep it on watch, but we're, of course, working with one of the largest in Europe in ONG, and we'll take every opportunity. We're in a couple of processes there to see if we can buck the trend. But I think our focus for now is on North America, both Canada, the US, as well as Asia Pacific, and I wouldn't rule out the Middle East. Again, Middle East, almost free gas, big industry, big players, big capital, and a big problem that needs a solution.
Okay, brilliant. All right, well, I've just got one last one from me, and then we'll pivot to some participant questions. Now, obviously, you guys, you have your core technology, and as you look to expand that technology into other sectors, obviously with steel making, with POSCO, what impact do you believe is going to have on Hazer's overall market value? And then obviously, continuing to stand as a leader in the hydrogen space.
Yeah, well, I'm convinced we're a leader already. We watch the peer group very closely. We know how competitive our technology is. We're the first mover in terms of really big commercial customers worldwide, so everybody gets it. The POSCO deal is really exciting because it kind of is a watershed moment for our penetration, if you like, into the steelmaking industry. Steelmaking and iron manufacturing is accounting for somewhere between 8 and 10% of the world's global emissions. It's a massive industry with a massive problem. We've got a very unique solution. POSCO is validating that, but that's opened up a lot of other discussions with other steel makers in Japan as well as in North America, and in the Middle East as well. So, these deals are very important for us, Ryan. As we kind of push through them, they validate the tech. They also really highlight how competitive our tech is. And it's not just the hydrogen side, it's the graphite. If you unpack steel making, it's just as much about carbon and our graphite as it is about our hydrogen. And there's two pathways in steel making. There's the blast furnace, which is the traditional path, which needs lots of carbon. And there's the DRI and the electric arc furnace path, which needs lots of hydrogen and lots of carbon. And both of those are perfect for Hazer technology disruption.
Okay, brilliant. Well, thank you for answering those, Glenn. Really appreciate it. We'll just go to some live submitted ones now. So the first one I've got is, what is Hazer currently doing with the hydrogen it's producing from the CDP?
We produce a lot, and we're not selling it yet. I think we'd like to be. It is a demonstration plant, so the objective of the plant is to obviously demonstrate the technology. It's not in a region. It's just slightly south of Perth. It's a big industrial complex around there. I think that we are currently engaging stakeholders in the region to see if there's a market for some of the hydrogen. But at this stage, we're kind of focused on demonstrating the tech as opposed to selling the product streams.
Yep.
That said, we're of course an entrepreneurial organization. We are looking for avenues for offtake for even the small volumes of hydrogen as well as the graphite, to get price validation on it. But watch this space. It's not the main objective, but there is volume available, hydrogen as well as graphite, and we'll continue to engage stakeholders on that.
All right. Well, brilliant. Thank you for that one. Now, next up, I've got, do Hazer get the biogas for free, or are you being charged for it, for the CDP?
As well as I do, Ryan, nothing's for free. We don't pay much. It's a nominal cost.
Yeah.
What I will say is that we're very privileged to be working alongside Water Corp, who is obviously the supplier of the biogas to us. We do pay a nominal amount. It's heavily discounted to the normal gas prices, but it got the process going. It was also important for the ARENA funding. And the reason we have ARENA and government backing for this particular demonstration facility is because we use biogas and it's a carbon negative process. We do actually get the land for free, so there is something for free in there, but it's a nominal cost. Doesn't drive the economics or the corporate side of our business, but it is the biogas and Water Corp are a really important stakeholder for us.
All right. Well, thank you for that one. Now, moving on, I know Hazer is chasing after the low-hanging fruit. Can you tell us if the novel graphite purification method that you were experimenting with has been progressed further in the background?
Yeah, I would encourage listeners and viewers to go onto our website. We put out an announcement this morning on our extension of our collaboration with Mitsui, as I've said. There's a lot more detail in there in terms of the possible applications for our graphite. There's been years of testing on this, lots of market engagement. What is emerging from all this is very positive feedback and application of Hazer graphite in industries like steel making and manufacturing, water purification, concrete, cement, asphalt, bitumen, a broad range of thermal energy storage, which is a new market, broad range of potential applications, big price points, anywhere between $600 a ton and over $1,000 a ton, some of these markets. So it's a massive value kicker for us. If we need to purify it, that's also an option for us. We don't see that as an immediate option because there's potential for already large markets that we can drop our product in without any pre-treatment. Of course, we've tested even our graphite in lithium-ion batteries. It works. We know that. There's a little bit of post-processing to do with that, but it's not a massive market. But if we can capture whatever market we can at any price point, Ryan, we'll take it. But even securing offtake at $500 a ton is a massive value contribution to the overall economics for any customer here. Graphite.
Okay, all right. Well, thank you for that one. Now, moving on, is the Hazer process using methane as a feedstock sufficiently green process versus hydrogen production from the electrolysis of water, assuming green energy is used? All right, what is the cost comparison of the Hazer process versus electrolysis?
I wish I put another slide in. It'll come out in the coming weeks as we sort of get on the road again. I'll just break green hydrogen down again for you. It takes 55 kilowatt hours conservatively to split water into hydrogen and oxygen.
Yep.
It takes 8 to 10 kilowatt hours for Hazer to do the same with gas.
Yep.
You can already see it's 7 times lower energy required to do what we do. So if you plug both ourselves and an electrolyzer into the grid, forget renewables for now. If you plug them both into the grid, you're going to have 7 times the emissions with electrolyzers. Okay, that's the chemistry and the principal reason why electrolyzers need a renewable power grid, because they consume a lot of energy and they would effectively emit a lot of carbon as a result. Our lower energy intensities, of course, we can be part of a renewable power grid, but we already cut emissions from the current hydrogen production system, SMR, in half before we do anything. And so, that's the journey that we're on. Why don't we start now in, cutting emissions in half or 2/3, and we'll deal with the rest of it later. But this is Hazer's disruption, that we can immediately replace a dirty form of hydrogen today by cutting emissions at least in half, probably more. And then as we go through, renewables becomes a real option for us, and we can start to reduce further beyond that.
Okay, well, thank you very much. Now, next one I've got is a bit of a mouthful here. Now, is the initial revenue for work done so far likely to remain consistent on a month-to-month basis going forward? Secondly, how can you declare commercial readiness prior to testing the Mark II reactor? And switching to the Mark II reactor will obviously be costly. How and when will you need to obviously source more funding in order to do this?
Yeah, they're quite detailed questions. On the Mark II, I think people that follow the story, our second generation reactor, which is effectively the reactor to get us up to large scale units of up to potentially 40,000, even 50,000 tons per annum. The prototype for that's already built, so the capital's already spent. So it's simply just a replacement of the current reactor that we've got into the CDP, not a costly exercise. And I will just touch on the funding point so that people are aware. We're actually pretty robustly funded. If you go back to our last quarterly, I think we had $12 or $13 million of cash. We don't spend much on a monthly basis. We're not building anything, at least anymore, in terms of the CDP. So our cash burn has actually come right down. I think it's close to $1 million a month or even less. So you can see that we've got the pathway and the runway. We always, every year, get an attractive R&D rebate through the Australian government. So that again is in the order of $5 or $6 million. So you can see already that we've got, and we're getting income from the engineering services side from one of our partners already. So we've got good liquidity. We've got more ARENA funding coming in January of next year. So we've got an extended pathway through some pretty serious inflection points and milestones. We raised much earlier in the year, I think it was February of this year, and put ourselves in a very strong position to get through, some, as I've said, some pretty significant milestones. We've got more inflows and non-dilutionary inflows on the way, and that should set us up for good, strong, midterm liquidity. Ryan, what was the first question? Sorry.
The first part of the question was, is that initial revenue from work done so far likely to remain consistent on a month-to-month basis going forward?
Yeah, it'll depend on the work we do.
Yeah.
And I think the model is there. it'll fluctuate depending on all the work that Hazer and we do to support that project. But I will also say that's the model that we're going to put in place for all the other projects we've got. So as they get to mature points where we can do that, that'll be the same model. So ultimately, our business model will be covered mostly by the commercial projects, and that'll put us in a very strong position as we move forward with future inflows.
Well, brilliant. Thank you for that one there. Now, a couple of others here. When is Hazer likely to progress to TRL 8?
It's in flight. This is TRL 7.
Yep.
TRL 8, which is pretty much close to the top of the list, is our Fortis project in Canada. So that is the TRL 8, and as I've said, we're well advanced on all of the engineering work there. So it's a really mature project, and with an FID next year, then we're again getting very close to that TRL 8 position, and accelerating through to kind of a commercialization tech. But the numbers are a little bit grey depending on where you are. But I think what's really important to take away from this is that our tech is commercial ready. It's de-risked. Customers are now starting to pick it up. We're in advanced stages on some of the early projects, and that is really where we want to be from a technology perspective, and worrying less about the numbers, so to speak.
Okay, well, thank you. Now, just to pivot back to the CDP here briefly, a participant asked how much graphite has the CDP produced to date?
I don't have the numbers to hand. It's in the tons. We've got now bags of the stuff. Why that's important is because you will have seen in today's announcement, customers are demanding it. Or prospective customers rather are demanding it because they can go through this round 2 of testing.
Yep.
A lot of the testing has been done already, but on smaller scale samples. As we now have hundreds of kilos and tons of it, we can basically now ship off. As folks would have seen, we put 100 kilograms into the post to Fortis recently, and there'll be more on the way to other prospective customers and off-takers for really important testing, including Mitsui and all of the customer base that they've got behind them. So it's important that we get this out, some of the high purity stuff, to really get this into some of the applications that I've spoken about earlier.
Okay, thank you. Now, just on the topic of Fortis, have they identified a site for their plant yet?
Yeah, they're still working on it. We actually had Fortis here in the office last week. Some of the senior management. I think that's again a really strong signpost for the relationship as well as the progress that we're making. They're amazed by the tech. Some of the words were, "Wow, this is amazing." We're happy with how the tech is progressing. So we're moving forward with that particular project, and as I've said, we're on track with that. Their site is critical. If you wind back the clock about a year and a half ago, one of the partners had to pull out for corporate strategic purposes. That site is not available. They've got a short list of sites in the Vancouver area that we're exploring, which some are really exciting, and they've got some potentially really exciting offtake opportunities for both importantly the hydrogen, but also the graphite. So we're aware of the importance of it. The feed is done almost up to the point where you need the integration, so it's becoming a critical path. But we spoke about the importance of that and the strategy to select the right site, and we're confident that Fortis are going to deliver.
I appreciate the update, Glenn. A couple more here. Now, I don't have too much context for this one, but a participant asks, is the hatch ready for installation? If not, when will this be?
Yeah, that's in the detail. Yeah, it is. I think we've put a picture into one of the recent announcements, so people can see it's for real. The reactor is well advanced, and like I say, it's ready to rock and roll. So we're looking forward to putting that in as soon as we're finished with the test program that we've got running at the moment on our first generation. But that reactor, super critically important, because it's the reactor that feeds into the commercial projects up to 50,000 tons per annum. So if there's any confusion about it, it is the reactor that is going to be the single important piece of the commercial projects as we go forward. Testing of it is critical, and that's what the CDP is here for.
Right, thank you. Now, just to pivot back to some financials briefly, in estimating the NPV for each facility, how much is the graphite value considered?
I think in our investor presentation that we've consistently put out, I think we value the graphite in the order of $400 a ton, which we are confident is at the lower end. You can plug lots of numbers in there, lower or higher. They all deliver value of certain levels. But that is from our read, as well as the feedback that we're getting from market at the lower end of the pricing points. We know one of our big peers in North America is selling their carbon black, not graphite, carbon black, which is amorphous and arguably lower value, for over $1,000 a ton.
Okay.
We're not so bold to put those numbers in, but if you would see that the numbers and the underlying economics of these projects are very attractive. Our tech doesn't rely on the graphite. Yeah, it's a two-stream. Like I said, it's one tech with two product streams, hydrogen and a critical mineral. It's a value kicker. So if people look at it like that, it's significant value upside.
Right, brilliant. Now, a bit of a niche one here, testing knowledge. What is the diameter of the Mark II reactor?
Oh, I'll have to pass on that. I think it's IP as well. So if I may, I'll just defer that one for next time.
Very much understandable. All right, well, I think we've just got one more to finish this off, Glenn. Appreciate your time as always. Now, how does Hazer compare with plasma tech?
Yeah, that's a good place to stop, actually. Plasma. So I mentioned the peer. Plasma is, think of, I'm a physicist, not a chemist, so forgive me if I get this wrong, but plasma is very hot torches, effectively, yeah, and they require somewhere in the order of 2,000 to 3,000 degrees Celsius to get up to sort of full temperature, and that's the plasma tech. If you go back to our original technology slide where we use the catalyst, we effectively heat up our reactor to anywhere between 800 and 900 degrees. You can see we're at least half, if not a third, of the temperature that plasma's at. So you immediately see that as the proxy for cost. And if you're a third of the energy and the heat, then you're going to be, obviously, a fraction of the cost. So that's what some of the other techs in this space are doing. One of the largest is in the US. They're valued at $1 billion. Okay, so again, we see that as a value marker with a tech using plasma, as one of the viewers has asked, which is a higher temperature tech, a higher cost tech, but still getting very high valuation. So that's the trajectory and the vision for where we're heading. The numbers stack up. We've got, visibility on that, and that's the excitement of what we're doing. And like I say, we love the vision that we've set. We love that we're not there yet, Brian, but that's what's keeping us, going in terms of developing this world-class tech to where it needs to be and putting it in the hands of those that need it most.
Oh, brilliant. Well, it's really good to get that understanding. Now, Glenn, just before we finish off, mate, once again, thank you very much for your time and expertise this afternoon. Is there anything you'd like to leave us with?
No, I would. Firstly, thanks to all the listeners for hearing the story. I'm at the risk of kind of repeating myself. This is a world-class decarbonisation climate technology. Okay? We're decarbonising gas. We're not green hydrogen. We stand apart on a number of characteristics. We're low cost, low energy. We've got a really differentiated graphite product, which is a diversified earnings product stream for us. We've got first mover advantage. We're validated by some of the world's largest companies out there: POSCO, Mitsui, Fortis, Chubu, Chiyoda, Ongi, Wood, Hatch, and others. This is a story that's coming together. We think we feel like we've been unfairly hit by some of the headwinds of green hydrogen. But as people understand the importance and the simplicity of our story, then I'm pretty confident that the market's going to get it. We've just been covered by another analyst that's put a pretty sizable valuation on us as an independent valuation. So that's available for folks if they want to see an independent view of the company. But we're excited about the vision. We've got massive inflection points coming over the next 12 months. And, we welcome investors and shareholders to jump on board.
Well, once again, Glenn, thank you very much for your time and expertise this afternoon, mate. Thank you again to Hazer. And ladies and gentlemen, enjoy the rest of your day. Cheers.
Thanks, Ryan.